The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Become a Pro course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Hello and welcome to the Become a Pro course here at Forex.Academy. I am, of course, your host, Robert Blackwell, and I have the pleasure to walk you through today's lesson. Today we'll be discussing sector analysis in very fine detail, leading us on to discuss the market structures of equity markets and how sectors affect global growth across different markets, of course, with capital trade flow and currency movement. So before we move into our lesson, of course, let us consult the following disclaimer. There is risk inherent when trading in financial markets. And just a few pieces of housekeeping before we begin. Of course, it is a live interactive webinar, so do make use of the Become a Pro course capability to ask questions throughout. You can locate your chat box on the right hand side of your screen. So as we go through the webinar, please ask questions there. I'll be able to see them and provide full support. The live webinar is being recorded and will be placed into your members login area once we have concluded. Okay, so for revision purposes, you will be able to consult your members login area roughly around 1 or 2 hours just after this lesson. And we will, of course, be hosting an extended Q&A session towards the end of the live webinar to really go through all of the matter in great detail. If you have questions, I'll roughly cordon off around 15 minutes for Q&A time towards the end of the webinar. Okay, so let's just consult again or recap. We finished off there with the forces of supply and demand, really giving us an in-depth analysis to those market forces, how they affect not only commodity markets or more structured equity markets in terms of investor demand, but simply how they affect the forex markets as well, with capital flight and an increase or decrease in the supply and demand functions for a currency over one other. Today, more specifically, we will be jumping into sector analysis. Now, what does this mean? We'll be looking at how economies intrinsically operate, what part of the economies are strong and producing growth output, what part are potentially lagging and not really contributing to overall value in the local market. And that extends, you'll see that all these markets are intrinsically linked as they start to grow over a potential, well, depending on the business cycle, of course, a bullish business cycle as if now, you'll see how intrinsically linked all these economies are. So let's move forward then, of course, with today's particular lesson. First of all, let us define economic sectors. Really, what are economic sectors? How do we define them in terms of dividing those sectors? Well, we have, of course, the division of contribution to gross domestic product, a division of the population by economic area of employment, the innovation of natural resourcing and technology leading to business creation, and other intellectual activities including education, research and government. Because of course education, research and government, they add value, they add gross value in some form or another to overall production of an economy. If it's research and development, of course, there's a lot of finance goes into that. If it's government change, of course, there's finance goes into that. And education, of course, a lot of money and capital trade flow goes into education. So really that's how we define our economic sectors. In terms of the divisible sectors, what we define as is three main formats. Okay, so we have cyclical sectors, and these are sensitive to economic shifts. So we see them contracting and expanding along with the economy. Okay, so when we see times of economic boom and growth, of course, we see cyclical sectors start to shift towards that contraction, okay, expanding along with the economy and vice versa. Then we have more defensive sectors, reflects essential consumer needs, so virtually immune to economic development. So certain products as well share this same theme where, of course, basic food, staple diet food, things like these essential consumer needs, really those products, those companies or those sectors within an economy are immune to a certain degree in terms of economic development. And then we have sensitive economic sectors. They are in between cyclical and defensive, not immune to or acutely affected by economic shifts, but to see the type of products across all these sectors in terms of manufacturing, chemicals, and production that actually move with different movements of shift of growth or unemployment within the economy. So let us put this onto a map. We see potential growth here in an economy. What we have is, first of all, cyclical sectors. Okay, so these are more like materials, financials, consumer discretionary. Then we have defensive sectors, more like consumer staples. So I mentioned, the consumer staple like food, diets, of course. Telecommunications is, of course, defensive because nowadays we all need that level of communication in our lives, even when there's not necessarily economic growth within the economy or the local economy. We use telecommunications each and every day. Healthcare as well is something that is most certainly a necessity, and of course is very, very much a defensive part of the economy. And then more sensitive data in terms of that, defining that as a sector of the economy, we have information technology, energy, and industrials. So let's just choose one for a moment. We know that energy, of course, is focused on providing energy to the local economy, and of course, it's supplemented by a growth in potentially oil prices, which again, when we see strength in the economy or global growth as the overall business cycle story, we see more demand going into energy products and therefore more demand going into shares in energy company. They can then reinvest in their capital growth perspective and lay the cost on to the consumer. So again, a very sensitive sector of the economy, industrials, energy and information technology, depending on what the overall story is. So let's just go through in a little detail again with the type of actual sectors that actually make up the economy will define it, and there is a lot to take in here, so I'll just run through what these actually are. Cyclical sectors of the economy we define as more manufacturing, chemicals, building materials, and paper products. These are engaged in commodity exploration and processing. Okay, banks, savings and loans, asset management, credit services, investment brokerage, insurance, and property management. So again, heavily in terms of high finance, a very cyclical part of the economy. And what will later define, of course, is not just sentiment changing in terms of the business cycle, but there is now, since I suppose the creation of global finance interconnectivity, we see a more cyclical financial story that is separate to the business cycle itself in terms of systemically important to overall growth. Retailers then and auto parts, manufacturing, residential construction, lodging facilities, restaurants and entertainment. Okay, so they're all defined as cyclical sectors of the economy. In terms of sensitive sectors of the economy, we have manufacturing, food, beverages, household and personal products, packaging, education. Again, all staple needs that we need no matter what the growth story we are now facing in the economy. Biotechnology, pharmaceuticals, of course, there's always a need for medicine, research services, home health care, and medical care. Communication providers, internet services, and related software. Okay, so I realize there's a lot to take in here, but I'm just giving you at the start of this lesson some context to defining the different economic sectors within an economy so that you may develop ideas organically yourself as a trader. Okay, so let's take an example here of a sensitive sector of the economy. Again, pharmaceuticals, so within the middle there, we're going to see a level of stability given it's more sensitive to certain shifts in the economy, and that will affect your trading of such companies, perhaps Novartis there in Switzerland or GlaxoSmithKline in the UK, large pharmaceutical firms. Their share price will of course be more sensitive to certain shifts in that economy. Okay, and that's totally prevalent in terms of understanding the local current economic environment in which that company trades. Let's move on then to the defensive sectors of the economy. We have oil and gas producers, refineries, services and equipment company, pipeline operators, manufacturers of machinery, handheld tools, industrial products, aerospace and defense firms, designers and developers of computer operating systems and applications, equipment, data storage, and semiconductors again. So they're much more defensive, they're much more focused on manufacturing. Now they will of course develop a level of return because no matter what the business cycle, they actually employ a lot of people, so it's more intrinsically focused on the level of industrial output that the economy produces, and that's why they're much more defensive. Again, if we think of some of these products here, well, manufacturers of machinery or handheld tools, what springs to mind is agricultural manufacturing there, and of course there's always a need for manufacturing of tractors and things like this, so we can go out and farm the land and create produce for the local economy. So we now know, different factors or different sections of the economy that build up the overall economy. How do we actually value the economy in terms of what those sectors add or contribute to the economy? Well, we typically do this by defining gross value added, or GVA. So as gross domestic product outlines the total output produced by an efficient economy, the contribution to an economy of a particular industry or sector is measured by GVA. Okay, gross value added. Which sector is adding or contributing most? As such, it serves to highlight the performance of individual sectors in the economy. Okay, and I have a bit of insight here into the FTSE 100 from the Financial Times here. In January 2014, a report looked at the contribution of the creative industries to the UK economy. Employment in creative industries had risen by 8.6% between 2011 and 12, against a growth of 0.7% for the UK as a whole. So you can see that this one particular sector of the economy is really outperforming in terms of not only employment, but I would imagine gross value added. In terms of relation, we're not at a very strong period. We're at a period of recovery there, January 2014. But one sector can come into the economy, create a lot of jobs, create a lot of business, and effectively, create a lot of growth over that time period there in the UK. The gross value added of the creative industries increased by 9.4% to 71.4 billion in 2012, 71.4 billion pounds, okay, accounting for almost 5.2% of the UK economy. Okay, so times were tough, of course. We're not seeing overall growth. We see the overall growth is 0.7% in the UK. But at the same time, there is one sector that is showing outperformance to the level of 8.6%. Okay. Now that happens all the time, and this is why I wanted to go through the cyclical sectors of the economy so that you can gather an idea of your role as a trader to actually actively get involved in these markets. Again, we'll use a more prevalent example. We have the Nasdaq 100 there, of course. In 2017, it was the gross outperforming sector of the US economy. And again, if you're able to position yourself within trading those sector equities, perhaps Microsoft, Qualcomm, Cisco Systems, Facebook, of course, they're outperforming and providing trading opportunity for you. So they're very important indeed. Let's define then the importance of economic sectors here. Financial trading involves constant assessment of the economic conditions of the economy. Okay. When we analyze the contributions of the components to the annual nominal growth rate, we are able to tell how the economy is performing, which sectors of the economy are promoting growth, and which are lagging and not adding value to the economy. Okay, so that's how important they are. Again, if we're equity traders and we're looking to make more profit in the equity markets, we pick one sector that is outperforming, of course. If we're looking to diversify and invest in portfolio across different nations, of course, we could, of course, again, I'll use the Nasdaq example. We can invest some of our hard-earned cash in US dollar denominated equities that are significantly outperforming the rest of the market. So perhaps Facebook or Amazon, some of these companies, while diversifying in other growth stories in the UK or abroad. Okay. And again, as a European example here from Eurostat, the biggest share of gross domestic product or gross value added here originating in non-financial corporations, around 60%, while slightly less than 1/4 is generated by household production activities, mainly the imputed value of the services from owner-occupied dwellings and small businesses. Okay, so during this time of recovery here after the financial crisis, this is what we see. The government accounts for around 15% of financial corporations for a small fraction of GDP. Okay, so the government is, of course, feeling some difficulty, feeling the pinch, more particularly in the Eurozone, where the ECB more or less requested for austerity across different nations, particularly here in Ireland, Portugal, Italy, Spain, and then committed these countries to austerity. They are feeling the pinch, bringing their overall level of production, government production, to GDP at 15%. Okay, so quite a low figure, and of course that's going to translate to many sectors of the economy. So I mean, we have a chart in front here where we can literally see contributing factors or sectors to the growth of nominal GVA in the euro area. Okay, and the question I would like to pose here to students online is, what does this chart tell us about economic sector performance, and how could policymakers adapt to support recovery? Okay, so we see households, we see government, we see non-financial corporations, and financial corporations again. More specifically, what we see is there's not a lot of investment coming in from financial corporations in Europe at this time. So of course that is indicative of a level of recovery, as we see governments more relative to more recent, I suppose, data from around 2014. We're not seeing a lot of involvement here at these levels. Nominal levels here where we have government, we see it's much less within our time period here. So that would support the basic principle that a government isn't doing enough, or they simply can't afford to do enough to support growth, and the ECB is maybe paying the cost for that, or the people in terms of taxes. So in terms of investing in an overall level of sector performance, we're looking for sectors that are adding value as opposed to those that aren't. So again, a totally hypothetical question for this simple example is, what I really want to get you guys thinking about is, how can this help us as traders? We understand perhaps the economic cycle that we're in. Of course, we're understanding the level of investment that it is going or not going into certain asset classes. How can this chart, or understanding this importance of economic sector performance, help us to make decisions as traders? Well, we know the contributions from financial institutions has been quite poor to the overall value, i.e. the gross value added since the financial crisis seen there previous. Might that sway the investment community or our decision as traders to go long or to buy financial corporations such as banks? Again, that's a question for yourself. Is this perhaps why European banks have seen very limited recovery as opposed to their counterparts over there in the US, who's experiencing much more strong recovery over the last 3 years? Again, so if you simply understand sector performance, not only in the overall Eurozone, but in one single market, then you're able to know not only which sectors are providing some support or strength, but which ones are weak, and how that leads into other asset class pricing. Okay. So let's discuss then economic sectors and index performance. Again, we looked at government there, we looked at financial corporations. How could one particular equity within a sector be influenced or influence the price of potentially an equity index or other asset classes? So here we have the FTSE 100, the weighting of the FTSE 100 UK market. Okay, the primary index of the United Kingdom, and we see that oil and gas contributes to a large portion. It's the overwhelming portion there, creating 21% there of, 14% of overall value to the UK FTSE market. Okay, BP itself is a very well-renowned company, British Petroleum. It is the third largest equity in its entirety, the third largest equity in the FTSE 100, with a weighting average of 7.9% of the overall equity index. So that's quite a large percentage of weighting. Now I know that there are some financials there. HSBC is the biggest component there in the FTSE 100, of course, around 10%. But considering that the oil and gas sector as well is so crucial to the UK economy, creating a lot of value to the UK economy in one particular market or one particular equity, of course, we have British Petroleum is contributing so much with employment, with overall value and expenditure to that economy, that there's going to be a significant level of correlation or reserve to pricing the equity and to overall market performance. Okay, and what I've done is actually chosen one example that we're probably all familiar with here, an unfortunate example, of course, to show you how significant this can have an effect. And this is how we should understand the relationship between, or the severe close relationship that equity performance can have to sector performance, to single stock performance as well. So again, to reiterate, BP is the largest equity, the third largest equity in the FTSE 100 with a weighting of 79.9%. This unfortunate accident is, of course, the Deepwater Horizon oil spill there, I believe, around April 20th, 2010. Okay, so it caused a huge shock, not only to a BP, but of course to the sector, to the overall sector. Okay, so we've just discussed how it's such a huge contributing sector to the overall market, the FTSE 100, and to UK performance and employment and all of these very important things. What is going to happen when there's a serious incident like this? We see, considering the drastic change in share price of BP's share and its overall weighting on the FTSE. Okay, now just to look at a sort of microcosm example here, really zoom in on the overall share price of BP here. We see from July around here, just in June 2000, around April 2010, I believe, we see a very sharp decrease in the share price of BP, and it takes quite some time there, potentially 6 months to 1 year to recover. Okay, so a very sharp decline in share price. So again, the question I would like to pose is, how significant is this in terms of the sector? How significant is this for the overall market? What we can do is do a study of this, of course. Here we have the date, indeed, Deepwater Horizon spill there, April 20th, 2010. That is the single candle there that we can actually see where this event happens in the market. Okay, so I'll just annotate this in a little detail. Just this candle right here. And again, it takes the market a little time to price in this news event, of course, to realize how significant it was, how much oil was spilled, what were the ramifications of this event going to be, and how is it going to price asset classes, and what effect is it going to have on the economic sector here in the UK, of course. And effectively, that's what we see, a very strong, this is the FTSE 100, of course, a very strong move in the price, a sharp decline in BP's own share, which we just seen. This price was felt, as well as a massive shock to the entire oil and gas sector, and to the FTSE 100. We see a very sharp decline in oil pricing as well, albeit there may be other factors, of course, in pricing in this move, of course, but of course it is causing a huge shock to the sector and to the FTSE 100 itself. Okay, and this is effectively what we see, guys. With such heavy weighting on the UK equity markets, the FTSE was sent spiraling just after. Okay, so that's how we can really use one example to explain how significant equity market performance is. What we can look at is a series of different equities, and we know that we had a financial crisis there with the systemic collapse of Lehman Brothers and the financial burden that was felt across equity markets globally. What we can do is simply understand one sector and its importance in the overall story of economics, and us as traders to look for those price moves. Okay, let's go back to here. There we are. So here we have in front the S&P 500, and I'm just going to denote just with a little dot on this price chart here, the S&P. This is actually a line graph showing the overall price movement over a long period of time here, and we'll start with roughly around middle spring here, 2008. We see the big moves from the financial crisis here, and these are the all-time lows in the S&P. Okay, so we know this is going to have an effect. We know it started in with the mortgage and housing crisis, but it was all interlinked with the financial crisis. Evidently, the shadow banking crisis, of course, as well, really was the catalyst for a large portion of the move, filtering across the whole financial sector as well. So it just brought to light for us as traders and economists how significant the financial services sector is in terms of intrinsically linking all of our accounts together, all of global finance and trade. But how might this affect the overall level of market activity across the globe? So what I've actually done is to discuss some of these equity markets with you here. We have the S&P 500 trading over the long term to the downside, and then the level of recovery thereafter up to a recent date here, around 2012, just when we see a period of market recovery coming into play. What I'd like to do is just go over some other European and markets here. We have the Nasdaq 100 again. You can see the significant correlation between the sector performance across different markets as well. Then we have, of course, the FTSE 100, a totally different market, of course, across the Atlantic, but you can see the sharp decline in share prices of those constituent companies within the FTSE 100, given they do, of course, a strong level of business with all of these US banks, of course, and all of these sectors are intrinsically linked. We have the DAX again, which shows very similar price action, and again the CAC 40 there in France, showing, albeit a lot more volatility. Again, Europe had its own problems as well, but we can see there's an overall decline in the overall equity index performance, and then an overall recovery story yet after, as we see from a period of around 2009 lows, February 2009, we see effective recovery over such period across many of these equity sectors as well. So it not only shows us that these markets are correlated, but that they are reliant on sector performances that are intrinsically linked, of course, for overall growth across the global equities and global growth stories as well. So what I'd like to do then, just to take away that annotation, is go through a very important case study. I've actually chosen the country Switzerland here to define economic sectors, their importance on trading the local economy, their importance of understanding trade and capital flow, their importance on trading currency pairs as well. And this, it is very important to choose one case study to show you how these asset classes manifest themselves and how trade manifests itself across global markets. Okay, and this is you can literally do this for every equity index or every country that has a free market there, to show you how everything is linked and to show you the importance of strength and weakness between economic sectors. So I'll advance forward then with our case study of Switzerland. It's very interesting indeed. Some main points to pick then are, our focus is, of course, to identify the contributing sectors of the economy and the gross value added. So what is the gross value added from all of those contributing sectors? To discuss the impact of sector trade relations with the rest of Europe. Okay, so we know exactly geographically where Switzerland is, and it's very important that it has very strong trade relations with its neighbors. To analyze the domestic equity markets and principal equity index. Okay, and you're going to see as a trader how value is added across equity sectors, how value is added across different economic portions of the economy, how that creates unemployment, how that creates more trade between nations, and an overall level of value that we can assess across asset classes. And obviously that's our job as traders, to speculate across these asset classes.